All right, welcome. This is Silas Umekwe, and in this video, I'm going to be talking about a very important topic. Are you an investor or a gambler? Now, who is a gambler and who is an investor? Because for us to be able to understand our personality when it comes to trading or doing business generally, we need to understand who we are and our level of participation in the business world. Now, are you an investor or a gambler? Now, before I go continue with this video, if this is the first time you're watching my channel, please be sure to click the subscribe button below and click on the notification so you get a message as soon as I release my next video. Now, straight to what we have for today. Are you an investor or a gambler? Now, who is an investor? An investor is a person or entity who commits capital with the expectation of receiving financial returns. Investors can analyze opportunities from different angles and generally prefer to minimize risk. So basically, that is who an investor is. Now, but what is investing? Investing is parting with capital in the expectation of the safety of both the capital and adequate return on the capital in the form of dividend, interest, or rent. Now, since the returns is periodic, investing indicates an intention to be separated from capital for an extended period of time. Investing, therefore, is usually associated with relatively long-term horizons. Now, who is a gambler? A gambler is someone who gambles regularly, as simple as that. Now, but gambling is a derivative of betting. To wager money on the outcome of an event, contest, game, or pure chance. Now, gambling usually involves a game of skill or chance. Now, when we talk about skill, take for instance, you're betting against a match. Two players are playing. You're betting based on the skill of the team. You're betting against in a horse race. You're betting based on the strength of the horse. Now, but there is also gambling as a game of chance. Okay, I roll a dice. The highest number wins. Now, that's a game of chance. So the fact that you are involved in trading any market, it could be buying and selling of commodities, cryptocurrencies, forex, and all what you have, doesn't automatically make you an investor. Your activity does not make you an investor or gambler, but rather your approach to the activity. Now, not all card games are gambling, like you know. The same way, not all stock or cryptocurrency purchases are investing. Now, although gambling is more associated with games as it is derived from the word game playing, the major characteristic of a gambler is whether he wants to be right in his prediction or just enjoy the entertainment of participating. Now, the main aim of gambling is enjoyment, basically, guys. The main aim of gambling is entertainment because gambling deals with the unknown. It's pure chance. Money is only a ticket to this game. Now, to a gambler, all normal criteria of odds are irrelevant. I mean, they are completely irrelevant. For example, an example of this is someone who goes into a business with the mindset of, oh, let's just try this. I think it may work. Oh, I like the idea. Let's just try it. Now, I can tell you categorically, you are gambling. All right, so let's move on. Investing is the act of allocating resources, usually money, with the expectation of generating an income or profit. You can invest in endeavors such as using money to start a business. You can invest in assets such as purchasing cryptocurrencies in hopes of reselling it later at a higher price. Now, but in investing, risk and returns are two sides of the same coin. Now, what this means is that low risk generally means low expected returns, while high risk also means high returns, because higher returns are usually accompanied by higher risk. Now, what does investing and gambling have in common? They are both based on risk. Risk, risk. This word is very, very popular and very familiar to most of us here. Now, but the question is, but life itself is a risk. Life itself is a risk. Crossing the street is a risk, driving your car is a risk, starting a business is risky, operating a business itself is risky. So now the question is, what is risk? Risk simply means the possibility of suffering a loss. Now, if you can assign a numerical value, it becomes probability. We've all done this in our maths class in junior secondary. There is no guarantee of having things turn your way. There is no guarantee that things will turn out the way you want in any activity of life. Most people don't know whether they are investing or gambling, and to an untrained eye, they all look the same. However, the major difference is gambling creates risk, while investing assumes and manages risk that already exists. This is what we call inherent risk. Now, inherent risk is a natural occurrence. For instance, a farmer bears the risk associated with getting his product to the market or to his consumer. The same inherent risk exists in trading cryptocurrencies, forex, stocks, and so on. Now, but they are created risk. This involves the arbitrary invention of a potential monetary loss. Now, when you get into a business with the idea that make I just try, you've just created a risk. Now, the risk is not a natural byproduct of the activity. A football match can be played without any monetary loss, but once you decide to wager it, it becomes a created risk. That means if you are wrong, you lose something. Now, since life is filled with risk every day, estimating and managing those risks is a necessary part of our lives, and the probability is the mathematics of estimating this risk. Now, there are some psychological fallacies most people have when it comes to risk and probability, and they include: one, the tendency to overvalue wagers, including lower probability and high gains, and undervalue high probability and low gains. What this simply means is, take for instance, you are investing in a business that promises 200% in 2 hours as against 0.5% in a month. The normal mind, the average mind will tend to go towards, he will overvalue the low probability and high return risk. That's the idea. Compared to the, you now undervalue the high probability and the low gain. Now, there's a tendency for every natural human being to act that way. Now, this is the first fallacy. It's a psychological fallacy. Now, the second psychological fallacy we are looking at is the tendency to interpret probability of successive independent event as additive rather than multiplicative. Now, what does this mean? The chances of always being right in all your investments do increase astronomically the more you invest. It's just like jumping, from one project or investment to another. It's like throwing 5 on a die 4 times. Like if you pick a die, you throw it the first time, you throw the second time, and 4 times you throw a 5. And you somehow expect that to increase or improve your chances of getting a 6 on the 5th throw or on the next throw. So there is a tendency to interpret probability of successive independent events as additive, whereas it's multiplicative. The third fallacy is that after a run of success, failure is mathematically inevitable, and vice versa. That means it could also go that after a run of failure, success is mathematically inevitable. Now, this is also called the Monte Carlo fallacy. Now, a person can throw double sixes 10 times in a row. It's very possible and not violate any law of probability because each throw is independent of all others. This implies that you can profit from all the businesses you do without violating any laws of probability because the successes of each business is independent on the others. Now, the number four fallacy of risk is that the perception that the psychological probability of an occurrence of an event exceeds the mathematical probability if the event is favorable. Now, what does all this mumbo jumbo means? Now, take for instance, the probability of success of drawing a winning ticket in a lottery is like 1/10,000. And this is the same probability of being killed by lightning. Now, if we bring that, a normal mind will tend to think that the chances of winning the lottery is more probable than being killed by lightning. That means the psychological probability exceeds the mathematical probability. That's not true. It's a fallacy. It's a fallacy. Now, 10 years ago, a young man bought bitcoins with about 10,000 bitcoin. He bought pizza with about 10,000 bitcoins. Now, with over 7,000 cryptocurrencies, what is the probability that the next coin you spend your $10 to buy over a 10,000 units will be of the same value as Bitcoin today? This fallacy has left so many so-called cryptocurrency traders with hundreds of thousands of valueless coins. This is simple math, guys. You need to understand where you stand on this divide. Are you trading, or are you an investor, or are you just gambling? Now, once you understand how this risk works, it gives you a better perspective. It gives you a better understanding. Now, the fifth fallacy is the tendency for people to overestimate the frequency of the occurrence of infrequent events and underestimate that of the comparatively frequent ones after observing a series of randomly generated events of different kinds. What does all this whole shit I just said mean? When a trader makes consecutive gains of about 500%, he tends to overestimate that occurrence and he wants to cash in over 500, 600% on all trades subsequently, forgetting to take the lower short-term percentages that are frequent in the market, causing him to leave a trade longer than initially planned, setting him up for a huge loss. Now, this is a psychological fallacy. Now, the next, which is the last fallacy I have for today, is the tendency for people to confuse the occurrence of unusual events with the occurrence of low probability events. What that means is, take for example, if one holds a number close to the winning number in a lottery, he tends to feel that some unforeseen forces were involved in this terrible misfortune. His village people have finally come for him, and that's caused him to miss the prize. He just missed by one. Forgetting that the fact that it's an unusual event. It's an unusual event. So you don't confuse it with a low probability event. Your chances of winning the lottery is 1 in 10,000. The fact that you got a number before the winning number doesn't mean in any way that the unusual event is the cause. Now, another example is if you're told about an opportunity and due to your skepticism, you decided not to get involved, and eventually the opportunity goes so big and becomes a very huge success. You somehow feel that by some terrible bad stroke of misfortune, you missed your prize. Now, another word for risk is to expose to the possibility of a loss. That's another word for risk. Being exposed to the possibility of a loss and assigning a numerical value to that chance is erroneous. Is erroneous. You can't take for instance, in buying or selling a cryptocurrency, we are talking about unique, non-repeatable events. So we can't assign a frequency probability to this occurrence. You can't assign a frequency probability to the occurrence of profiting from buying or selling a cryptocurrency. This means that the probability of the market is not open to any kind of numerical evaluation. Most of the so-called gurus have told you to buy a coin that is going to be the next Bitcoin in 1 year, it should have proven to you that you cannot predict your profits trading the market. However, you can determine the amount of exposure to the probability that the market will hit a certain price or not. This simply means that all you can do is manage your exposure and losses. Also, that you tell yourself that you're going to do, I'm going to be trading with a 2 to 5 ratio, profit ratio. That means I'll risk $2 to make $5. It has nothing to do with the probability that the market will move to give you $5. The ratio does not say anything about the probability of that event occurring or not. Now, some so-called gurus that call other projects that they are not involved in scam are not smart enough to understand that business is risk. And even whatever project they are involved in can also meet a sudden end. Nothing is certain in life. Even the breath you're breathing now, you can't guarantee that tomorrow it will be yours. So finally, your involvement in business attracts two kinds of reward: recognition or money. Now, are you in the market for recognition? Congratulating yourself for calling every move ahead of time and explaining, or you are in the market to make money? Guys, why are you in this market? Why are you involved in that business? Are you there just because you are interested in the psychological rewards that you are right, man, I'm right. I called this coin last year and it has done 200x, it has done 500x. Is that the psychological reward you are there for, or you are there to make money? And guys, I can tell you categorically, most of the so-called gurus that are about, I call this thing and he did this, I call this thing and he did this, and I call this thing, this is sheer gambling. Yes, it's sheer gambling. Now, are you motivated by profit? Is it profit motive or profit motive? Now, what does profit motive mean? It means you're trading or you're involved in this business to make profit. Now, profit motive is that you're just involved in it to say, yes, I was right. Yeah, I took the call, you know. Like some of the persons that got involved in Bitcoin as at 10, 5, 6, 7, 8 years ago, you had no knowledge that Bitcoin was going to get to where it is. So it was not based on any particular skill of yours. So that you got into Bitcoin 5 years ago, maybe when it was $10 or $20 or even $100, doesn't mean you can accurately predict the next cryptocurrencies that is going to do so well. So stop being moved by all these psychological rewards, because the fact that you even got in so early is a gamble. Now ask yourself, are you profit motivated or profit motivated? Now, to answer this question, you need to figure out your level of participation. Are you a gambler or an investor? Examine your characteristics and behavior, the behaviors you are exhibiting, right? Not just the activity. Because you can be an investor playing games, and you can be a gambler trading the market. Entering a trade and betting a game can be your end or a means So your involvement in business attracts two kinds of reward: recognition or money. Are you in the market for recognition? Congratulating yourself for calling every move ahead of time and explaining, or you are in the market to make money? Are you interested in the psychological rewards that you are right, or to make money? Are you motivated by profit motive or the profit motive? To answer this, you have to figure out your level of participation. Are you an investor or a gambler? Examine the characteristics and behaviors you are exhibiting, not just the activity. You can be an investor playing the games, and you can be a gambler trading the market. Entering a trade or betting a game can be your end or a means. It is an end for those who yearn stimulation and excitement. I got the call. Those guys with a huge Instagram follower base, and they're after, I got this call right. I got this call right. I called this coin 2 years ago. I called this coin last year. Why are you in the market? Are you there to make money, or you are there to make noise, for fun? All right. And it is an end for those people like that are always chasing to catch the next big thing, jumping from one program to another. These are gamblers. And it can be a means for professionals who want to make money legitimately. So ask yourself this question in whatever business you're doing. It's not about the activity, but the attitude, the characteristics, the behavior that you exhibit towards that activity. That's what determines if you are an investor or a gambler. If you've gained value from this video, please be sure to drop a comment below, like the video, drop your comments, subscribe, and I'll see you in my next video. Thank you very much. I'm Silas Umekwe.